Fantastic. Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so good to see everyone today here from around the world. It is wonderful to have everyone. I want to start out by just going over the topic we're going to cover today, and that is value investing. Value investing has been made so famous by Warren Buffett of Berkshire Hathaway. Boy, there is so much press about Warren Buffett and Berkshire Hathaway. We're going to talk about really the evolution of value investing and where it's at today. But first, I want to just ask in general if anyone in here has any experience with doing value investing, where maybe you have, maybe you're using it now in your current investments, or maybe you've heard about it, just so I kind of know what people have experience with. Does anyone have any experience with value investing? The idea of buying stocks for less than the intrinsic market value. Has anyone had experience with that? Okay, it sounds like not a lot of experience with that. Let's go through the basics of how it works. I've got an illustration here that shows share price, and you see a red line that is intrinsic value, and then you can see how the market price is sometimes higher, sometimes lower. That's the crux of value investing. It was made famous by Warren Buffett and Benjamin Graham. Benjamin Graham wrote a book called The Intelligent Investor, and it was such a famous book. So many investors read it, and they still study it. It's like the Bible of investing for many investors. And this is an idea that has been made famous by Benjamin Graham's best student, Warren Buffett. So Warren Buffett went on and formed Berkshire Hathaway, which in the United States is one of the largest companies that has had tremendous success. And basically, he runs money for this company, and that's how that works. But in a nutshell, if you look at value investing, what you have is you've got a situation, and this chart kind of shows the idea. And you'll get a copy of this with the presentation, but there's three people that have kind of influenced Warren Buffett on value investing. The first is Phil Fisher, and he really advocated for buying and holding stocks for the long term. Then there was Benjamin Graham, and Benjamin Graham, he was a professor at Columbia University, and he advocated buying at the right price. So, you know, he had a lot of ideas on that. And then there's Charlie Munger, who is Warren Buffett's partner, and he advocated buying the right stocks. So with all of this, it kind of came together, and these are the final things that came out of it. It, you know, basically looking for attractive valuations, looking for businesses that are run by honest and efficient management, a business model that's understandable, and a business with a sustainable long-term competitive advantage. So that's kind of the framework on which it rests. And now the question is, well, that sounds great. You know, you're going to buy some stocks for less than what they're worth, but how in the heck do you determine what they're worth? How do you determine what they're worth? Well, you can do what's called a discounted cash flow projection. And this is where you would sit with a pen and a paper, or more realistically, it could be an Excel spreadsheet. And you're going to project out in the future, what do you think the cash flow is going to be year after year of the company as a going concern, the firm as a going concern? What do you think the cash flow is going to be? So you would do this, and then you're going to apply what is called a discount rate. And a discount rate, if you're looking, for example, for say a 10% discount rate, your R would be 0.1. So that's basically what you're going to be plugging in to get the answer. You're going to do this to get an estimate. Once you've got a value for the firm, then at that point you just can divide it by the equity to get a price per share, and then you can compare it to the actual shares that are outstanding. So the concept of it is you're taking the true value of a company and you're dividing it by the number of shares that are outstanding. This is a different method than doing something with multiples. A lot of people, they buy companies based on price earnings, and they compare company one to company two based on this one has this PE and this one has this PE. But with value investing, it stems from a cash flow valuation. That's what you're actually doing. You're trying to determine the value per share. Okay. So now let's talk about some of the terms that you will find in these annual reports. And these are important just to understand when you're looking at an annual report. So you would have authorized shares. This is when the company was initially incorporated, how many shares were authorized. And in this example, it's 2,000 shares. But it could be a lot more, it could be a lot less. And then you're going to look at, did the company issue all of the shares? Let's imagine the company issued 1,500 shares, and that there were 500 shares that were unissued shares. So then if we go back and we look at the issued shares, this could be broken down into two categories. The categories that would be outstanding shares and treasury shares. So outstanding shares are shares that actually are in the hands of people. So, or owners. So that could be the company's officers if they own shares. It could be the shareholders, of course, if they own shares. But there's another category of stock that is treasury stock. And this is just outstanding stock that is bought back from shareholders, or sometimes some stock is held in treasury. So when you're looking at this, it's important to kind of know what those terms mean. Now let's talk about the par value of a stock. And this is something that's very important, because when you form a new corporation, first of all, if you look at publicly traded companies, 100% of the time, they are going to have a very, very low par value. I mean, it's almost always a super low par value. And that's because when these companies are incorporated, they always select a low value per share to minimize the tax expense. But the par value of a stock is totally different than the market value. The market value is much higher than the par value. And sometimes you also will see maybe newer people that they set up a company and they may pick a higher par value per share. And this can lead to a result where later they end up getting a tax bill because if they write down a higher par value, and then the taxing authorities look at it, they'll say, oh, this company has a higher value, it should be taxed at a higher rate. And then, of course, the person, when they find out about it, they're going to go and refile a correction on that. But that's how that works. So, with, say, a company has 10 million common shares, startup might issue maybe 6 million to 8 million shares. And this is kind of a normal pattern. So that's essentially how the shares work. Okay. How do you value a privately held company? Well, that's a great question. The process is identical. You would value a privately held company by doing a discounted cash flow valuation, where you are going to have to make projections about what's going to happen in the future. So do you think that the privately held company will grow? Do you think that the privately held company will make how much profit each year? How much profit each year? And you would do this until you got several years projected. And then you could go and actually complete based on what R value you might use. Say you have a 10% rate of return, you might use a 0.1 as your discount rate. Say that's your discount rate, for example. So that's how you actually would determine the value. And then another thing that's real relevant and that's real important in this sort of thing is the concept of put forth actually by Ben Graham, that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So what happens is a company can get all sorts of positive publicity, and people get excited and they buy the stock. They say, well, you know what? There's so much news story about Tesla. I should go buy some Tesla shares. And then they go buy a bunch of Tesla shares. And if there's more positive news stories about Tesla, they will go and buy more Tesla stock. But then as soon as the news stories stop and something else gets news stories, they will go and buy the stock of the next thing. Oh, now I'm more interested in, for example, OpenAI, whatever it might be. And this is what in the short term drives the value, the perception of value, the number of newspaper stories about it that are positive. So that is what drives in the short run. It's a voting machine. But in the long run, every time a company files its annual reports, over time, there's a trend that starts to develop. And then this actually becomes more of a weighing machine, where if many, many years in the future, the company is always losing money, you know, that generally is a bad sign. Now, of course, there's exceptions. There's Amazon. Amazon for many, many years lost money. But the point is, this is something that kind of comes into play. And it's important to have some understanding of that. So I've got that's the presentation. I got just a couple of reminders, and then I'm going to stop the recording and I'm going to open it up for any questions. So let me just go through these reminders, and then I'll stop and I'll take any questions that anyone may have. So, okay, the sign-in sheet, please make sure you have that filled out. And I encourage you again to get a free account at www.feedban.com. And then also, if you have any friends or any colleagues that you think would benefit from being able to meet other investors from around the world, and we give everyone's contact information to everyone else. So you are welcome to contact each other. You are welcome to do different deals. So it is something that is good. The other thing is I also am available for mentoring if anybody has an interest in mentoring. So that is it for the meeting. And now I'm going to open it up for any questions or any comments. Just if anybody has anything that they noticed in this or anything, you're welcome to ask any questions. Let me stop the recording here, and then we'll do it.